Have you ever wondered how the rich keep getting richer? It's not just a stroke of luck or a winning lottery ticket. Rather, it's a systematic approach to wealth accumulation that's driving this widening wealth gap. The secret? Generational wealth. This isn't just about having money, it's about creating a financial legacy that transcends generations. Two strategies are predominantly used by the affluent to build and maintain their wealth over time: property investment and investment in the stock market. Property investment is a tangible asset that often appreciates over time, providing both income and capital gains. On the other hand, the stock market offers a chance to own a piece of a company and partake in its growth and profits. These aren't just strategies for the rich and famous, though. They're accessible to anyone willing to learn and put in the effort. So how can you follow in the footsteps of the wealthy and start building your own generational wealth? First up, let's delve into property investment. Now, what exactly is property investment? Simply put, it's the process of buying property, like houses or commercial buildings, with the aim of earning a return. This return could come from rental income, the resale of the property, or both. One of the main benefits of property investment is the potential for a stable income. If you own a property and rent it out, that monthly rent check can provide a consistent source of income. This can be especially beneficial in retirement, when you may not have a regular paycheck coming in. Another major perk of property investment is the potential for property appreciation. Over time, property values tend to increase, meaning your investment could grow in value. Think of it as a long-term savings account that grows over time. But, like any investment, property investment isn't without its risks. One potential risk is a property market crash. Just as property values can rise, they can also fall. If you need to sell your property during a market downturn, you could end up losing money. Another risk is the cost of maintaining the property. From fixing a leaky roof to replacing an outdated kitchen, the costs can add up. And if you're renting the property out, you'll need to keep it in good condition for your tenants. On top of that, there's the risk of vacancy. If you're relying on rental income, what happens if your property is vacant for a few months? That's a potential loss of income you'll need to factor into your plans. But don't let these risks deter you. With careful planning and research, you can mitigate these risks and make property investment work for you. It's about understanding the market, knowing what kind of property to invest in, and being prepared for the unexpected. In conclusion, property investment may seem intimidating, but it can be a solid strategy for wealth creation. It's a tangible asset that can provide a stable income and appreciate over time. Property investment may sound daunting, but with careful planning and research, it can be a solid strategy for wealth creation. Now, let's turn our attention to the stock market. Imagine walking into a bustling marketplace filled with vendors selling pieces of businesses. That's essentially what the stock market is, a marketplace for buying and selling shares of companies. When you buy a share, you're buying a piece of that company, becoming a part owner, if you will. Investing in the stock market can reap handsome rewards. One of the biggest benefits is the potential for high returns. Historically, stocks have provided substantial returns over the long run, outpacing other investments like bonds or savings accounts. This can be a powerful tool for wealth generation. Another advantage is liquidity. Unlike some investments where your money can be tied up for years, stocks can be bought and sold throughout the trading day. This means you can access your capital when you need it, providing flexibility. But let's not forget, every rose has its thorns. The stock market can be a roller coaster ride. Market volatility, the rapid rise and fall in stock prices, is part and parcel of investing. Sometimes the market can take a nosedive, and your investments can lose value. And that brings us to the risk of loss. Investing in the stock market doesn't come with guarantees. There's always the potential to lose part, or even all, of your investment, especially if you're investing in individual stocks of companies that might go bankrupt. But here's the good news. You can manage these risks. Diversification is your friend here. By spreading your investments across a wide variety of stocks, you reduce the risk of any single stock sinking your ship. Think of it like not putting all your eggs in one basket. And remember, investing in the stock market isn't a sprint, it's a marathon. It's about the long game, not short-term gains. Patience and discipline can be your greatest allies. Investing in the stock market may seem risky, but with a well-diversified portfolio, it can offer significant returns. You might be wondering, which investment strategy is better, property or stocks? Well, it's not as simple as picking one over the other. Each has its own set of advantages and potential drawbacks. Let's begin with property investment. It's tangible, something you can see, touch, and use. Plus, it tends to appreciate over time, and if you rent it out, it can provide a steady income stream. However, it requires significant upfront capital and ongoing maintenance. On the other hand, stock market investment can offer higher returns and greater liquidity. It allows you to own a piece of a company and potentially receive dividends. Yet, it's subject to market volatility and requires keen insight into market trends. So, is one truly better than the other? Not necessarily. A balanced investment strategy often includes both. Your choice should be influenced by your individual circumstances, financial goals, and risk tolerance. Ultimately, the better investment depends on your individual circumstances, financial goals, and risk tolerance. So, what have we learned today? We've discovered that creating generational wealth is more than possible through strategic property investment and smart plays in the stock market. It's not about putting all your eggs in one basket, but rather diversifying your investments across both sectors. We've discussed how to build a robust stock portfolio, focusing on a mix of high-growth stocks and stable dividend-yielding ones. And let's not forget the importance of timing when it comes to buying investment property. Buying at the right time can significantly boost your return on investment. We've also stressed the essential role of research and careful planning. Understanding market trends, doing your due diligence on potential investment properties, and keeping a close eye on stock market fluctuations can make all the difference. Remember, the road to wealth is not a sprint, but a marathon. Start investing wisely today, and you could be well on your way to creating generational wealth.